Imagine a colossal conveyor belt whizzing 3 football pitch-long cargo ships filled with the world's dirtiest fuel, coal. From a harbour in Australia to Asian countries with hungry power plants. Behind the scenes, however, things are far more complex. Countries and companies that declared coal's demise with ambitious eco-friendly policies are still banking on the business while financiers continue to pump billions of dollars into the black gold supply chain. Are you ready to uncover the curious story of how India, along with other developing countries, are keeping the world's dirtiest fuel alive? Stay with us as we embark on a remarkable journey into the depths of the coal industry, exposing the paradoxes and unexpected twists at every turn along the way. The UN says coal output must fall by 11% a year to keep global warming less than 1.5 degrees above pre-industrial levels. However, demand for coal surged past 8 billion tonnes in 2022. So, how is the coal trade, once destined for doom, thriving well into the 2030s? The answer lies in the 3 vital links in the supply chain: trading and shipping, expanding existing mines, and financing new projects. While many major banks have announced restrictions on coal investments, the financial sector's coal exclusion policies are wildly inconsistent. Lenders representing 41% of global banking assets have signed up to the Net Zero Banking Alliance, but very few have taken a stern stance against coal. In Asia and other regions, financing for coal purchases, mining and projects continue to flow despite existing policies. China and India's state-owned banks have remained tight-lipped about their coal exposure, allowing the existing mines to cater to demand until the early 2030s. Coal is cheaper and more abundant than other fuels, making it a lifeline for many Asian countries when energy is scarce. China alone is planning 270 gigawatts of new coal-fired plants by 2025, with India and much of Southeast Asia on similar trajectories. According to Boston Consulting Group, even with the Western world exiting coal, thermal coal demand will only fall by 10–18% between now and 2030. Investment banks predict that traded coal volumes will not drop below 900 million tonnes from 1 billion in 2021 for much of the decade. Existing mines are printing money as coal miners secure billions in bank loans, making it easier for them to tap into financial resources when required. With such robust support, the financing aspect of trading and expanding mines is not a challenge for the market. However, securing funds for new projects, the third critical link, might see a crunch in the coming decades. As Western banks retreat, Asian investors and family offices show a keen interest in financing new coal mines at home and abroad. The coal market of the 2030s will look vastly different from today, becoming more of a developing market commodity. Supply constraints will keep prices high and the cast of exporters cashing in will shrink. However, coal's prolonged farewell might continue well into the 2040s as renewable energy sources catch up. In conclusion, the coal industry is far from dead, thanks to the financial backing from the developing nations of Asia, led by India and China, who continue to support this dirty fuel. The future of the coal market is expected to cater primarily to developing markets, with supply constraints and high prices keeping the trade alive longer than anticipated. As demand may crater for good only when enough renewables come on stream in the distant future, coal will continue to play a strategic role in our energy mix as a last resort reserve for unexpected shocks. So, while the world strives towards a greener future, coal's stubborn resilience serves as a reminder that making the transition won't be as smooth or quick as many might hope.